Welcome. My name is Van Richards. I'm a chartered financial consultant, and today I'm here to help you identify different stocks that can help you accomplish your financial goals. A lot of times when I do one of these broadcasts, I talk about an individual stock, one particular stock, and we dissect that stock. We look at the stability, the earnings, and the competitiveness of that stock. Today is going to be just a little bit different. And the reason it's going to be just a little bit different is because of you, the listeners, you, the viewers that have requested that I take a look at a type of security that is truly unique. If there is a degree of uniqueness, it is here. And that is with mortgage-backed securities REITs. So we're going to take a look at the stocks that are associated with mortgage-backed REITs. So let's get started today with today's daily stock analysis. Thank you for joining me. If you are a regular listener, a regular viewer, but you haven't subscribed, subscribe, because I come to you on a regular basis with great information that can help you find those stocks, those investments that are going to help you get your financial goals, to get your financial house in order. So hit the subscribe button, hit the follow button. Now, the stocks that we're going to talk about today are organized based on REITs, and we'll talk about what that is in just a minute. But I want to identify the 5 companies that are out there, because some of you have said, you've written into me and said, hey, could you look at this particular stock? It's based on a mortgage-backed REIT. Or could you look at this particular stock and it's based on a REIT? So what I did is I took the 5 REIT stocks that were requested the most by you, the viewers, and I am going to talk about them just a little bit a day. Some of the characteristics that are associated with them, and I'm going to run down them real quick for you. Number 1 is Agnc Capital Management, which is paying a 10.62% dividend. Starwood Property Trust, which is paying a 8.45% dividend. Agnc Investment Corp, which is at 9.05%. And Two Harbors Investments, which is at 9.38%. And PennyMac Mortgage Investment Trust, which is at 10.08%. And we're going to take a look at this in a little bit different fashion as we go through this today. So let's take a look first off at how we're going to dissect this. We always want to start by looking at the stability, the earnings, and the competitiveness of any stock, and it can apply to REITs as well. But let's first make sure that we get an understanding of what REITs are. Hey, before I begin into that, I want to say thank you to my sponsor, which is Richards Financial Planning. If you go over to Richards Financial Planning, you can learn a great deal. And the way that I want to introduce this company, which is my company, is to pose this particular question. This question is this: have you ever heard anybody say, I regret sorting out my finances? No, you haven't, because nobody ever says that. The idea is that you can control your financial future with a financial plan, and it can ease your financial frustration. And you can learn how to do that by going over to richardsfinancialplanning.com. So let's talk just a little bit about what REITs are. I think that some of you identify REITs and you know what they are, but some of you are new to this. So bear with me just for a minute as I bring everybody up to speed and we get on the same page. Now, what is a REIT? It's an abbreviation for a real estate investment trust. It's actually a pool of investments. What happens is that there's money which is taken from investors like you and me, and then it's professionally invested in a pool of real estate investments. Now, the pool of ownership is divided up into shares. Now, REITs can be organized by shares, as we're going to talk about today in those 5 companies that we talked about. It can also be organized as an individual trust. You can buy one REIT, or you can go through mutual funds. You can go through exchange traded funds. You can also get into a thing called exchange traded notes, which I'd be real cautious about that, because the REIT debacle that happened over the past year really impacted exchange traded notes a great deal. Now, REITs have been around for a really long time. Dwight Eisenhower actually signed it into law in 1960. And there are 3 characteristics that identify REITs and make them unique. The first thing is that 75% of the holdings of a REIT must actually be in real estate. The second thing is that 75% of the income from the investment, if it's going to be a REIT, must be from real estate. And then the third criteria is going to be that 90% of the income that comes into a REIT must be paid out to you, the shareholder. If it fits that criteria and it follows a few other dotted I's and crossed T's, then it's going to be considered a REIT. Now, there are three types of REITs that are out there, and I kind of refer to it as the Napoleon ice cream, or Neapolitan ice cream, that is, of investments. Strawberry, vanilla, and chocolate, as you know. But the way that the three types of REITs are organized is one, which is equity REITs, two is going to be mortgage REITs, and then three is going to be a hybrid of those two. Now, what does that mean? An equity REIT is this. It's an investment in income properties that are designed to grow. And that investment in the income properties can be in office buildings, apartments, shopping malls, hotels, residential real estate. It's based on two things. One is the way that equity REITs grow is the income that comes in from the rental property or the lease property. And two is going to be the actual value of that real estate that goes up. Now, a mortgage-backed REIT is a different animal altogether. A mortgage-backed REIT is going to be a pool of loans. It's not going to be actual ownership in the property in itself. And there's really two types of loans that exist inside of mortgage-backed REITs. One is going to be construction loans, and two is going to be mortgage loans. Now, the mortgages are originated from three institutions that you may have heard of in the news. What these companies do, they actually issue certificates. They issue the loans themselves. The first one is going to be Ginnie Mae, or the Government National Mortgage Association. We're going to focus on Ginnie Mae because you could actually own a Ginnie Mae certificate yourself if you wanted to. We'll talk about that in a second. The second entity, now these are not government entities, but they are government-backed entities. And that's significant because the government guarantees that the loan will not default, but it does not guarantee the performance of the company that's holding the loan. That's an important characteristic to consider. The second one is Fannie Mae, or Federal National Mortgage Association. And then the third entity is the Federal Home Loan Mortgage Corporation, or Freddie Mac. All right. Now, how do mortgage-backed REITs make money? This is how they do it in itself. They actually either own the loans, they originate them, they make the loans for whatever that the business is going to be, whether it's going to be real estate mortgages that are based on residential or on commercial. They actually originate the loans. That's one way. That's the primary way. The second way is that they can buy and sell loans too. All right. So how do they make money in the loan business? And it is off of what's called the net interest rate spread. This is how it works. Let's say, for example, you have a mortgage. Right now, mortgages, I'm going to show you a reference to this in just a moment, but mortgages are around 3% right now. So if you get a mortgage and you get it back from Fannie Mae or from Ginnie Mae, you get a loan, let's say at that 1.25% to 1.5% that the REIT has. They loan the money to you, and they keep the difference between the 1.5% and the 3% that they get. That's called the interest rate spread. This is actually how it works. If you have a Ginnie Mae, and we're focusing just on Ginnie Mae's because they're easier to understand, they issue their loans in certificates. And right now they're at about 1.25% to 1.5%. So if you look in the news right now, you can see that mortgages really have gone up to the highest rate since July. This is an article which is in today's show notes that you'll see either on the podcast channel that you're listening to in the show notes or in the show notes on YouTube. But 30-year mortgage rates right now are topping 3%. Actually, it's more like 3.02%. So this is the way that REITs make money. They are getting the loans that they're making out, and they are issuing those at 3.02%. They went to Ginnie Mae and they got money at 1.5%, and they get to keep the profit of 1.52%. That's what they get to share with you if you own the REIT. That 1.52% culminates into the profits, that 90% that has to be paid out. All right. What are some of the dangers that might exist in mortgage-backed REITs? And the biggest thing that's going to be a danger is going to be interest rates. What's going on with interest rates right now? They're going up. And what happens when they go up? Well, it affects the value of that particular REIT a lot. And let me give you an example of this. It's kind of like the way that bonds work, because it actually is a loan, but it's not really a bond. This is the way that works. I'm going to give you an example. When you have interest rates in the economy that are going up, you'll have loans, whether it's going to be through a REIT or through a bond, and it's going to go down. Let me give you some numbers as an example. Let's take that Ginnie Mae that I was talking about a few moments ago. If you got a Ginnie Mae certificate 1 week and it was paying 1.25%. Now, they actually pay it out more frequently than 1 year, but let's say that annually that $25,000 certificate at 1.25% is going to pay $312.50. All right, now hold on just a minute. You've got your Ginnie Mae certificate at 1.25%. You're holding on to that. Now, next week, somebody else, your buddy, your friend goes out and they say, I got a Ginnie Mae too, but I got a higher interest rate. I got 1.5%. What's that mean? That means that your friend that went and bought the Ginnie Mae only had to pay $20,833. All right, let's say that you're in this Texas catastrophe that I'm going through right now, and you got to replace your plumbing, and it's going to cost you $25,000, and you need the money today. So you've thought, well, the only way I can do it is I can sell this Ginnie Mae certificate that I have. All right, I bought it for $25,000. It's paying 1.25%. So I got to sell it. How am I going to sell it? I'm going to go back on the open market and I'm going to sell it. But the problem is going to be, you're going to be competing with those interest rates that are prevalent at the current time, the 1.5%. You're not going to get $25,000 anymore out of it. You're going to get $20,833 out of it. That 1/4 point increase in interest rate made your investment drop by 16.67%. That's a rule of thumb. Now, what's the rule of thumb? The rule of thumb is this is just a general example. It's different in real life, but this gives you the indication. You understand that when interest rates go up in the economy, bond values or REITs are going to go down. Now, there's another hidden danger. Interest rates are something that are pretty common. A lot of people understand. The other hidden danger is what really hit some of the REITs that we're going to talk about, the individual stocks. It hit them a great deal. And that hidden danger is this. Some REITs are utilizing margin borrowing, actually borrowing from brokerage houses on margin to get money. They're not just going to Fannie Mae or Ginnie Mae or Freddie Mac. They're going to the loan to borrow money from mortgage from the investment houses, just like they're borrowing for stocks. Now, that comes back to bite them because those margins, they have margin calls. The money's coming due. All right, so how's that affecting things going forward? There's an article which is referenced today in today's show notes that the title of it is this: Mortgage REITs come under stress that even the Fed might not be able to ease. And this is from a year ago, March of 2020. Now, what do I mean? What happened? Well, those margin calls started to become due for REITs that were organized. They went out and they were borrowing money from the brokerage houses and they couldn't pay it back in time. Now, the managers themselves, since they couldn't pay it back in time, they were forced to sell some of their loans into the market while the values were crashing. So they lost value there. The third thing is they were participating in a type of security called a repo, and they were forced to buy or borrow money at higher interest rates through the repos. And then the third thing is the dividends on these REITs started to crash. We're going to see how that worked out in just a minute. Some of the REITs themselves have come back in value. Some of them haven't. We're going to take a look at the 5 that I mentioned just a minute ago. I'm going to make this just a little bit bigger for you so that you can identify it a little bit better. But if you're looking at the screen, and I'll describe this to those of you that are listening on the podcast, this is a spaghetti graph showing the value of the 5 REITs that I discussed at the very beginning over the past year. So the one that's actually done pretty well is the Agnc Capital Management, and they're based mainly on commercial mortgage-backed securities, not more residential. And if you look at the spaghetti graph, it's in blue, and you'll see that they went down quite a bit around in March and April. They were down around 50% in value, but they've come back to where they're just at about even for the year. No loss, no gain. Is pretty even from that standpoint. But when we look at some of the other different investments that are out there, like Starwood Property, now Starwood Property is going to be a little bit different because it's based on US and European REITs, not just the US REITs, which the rest of these are. With Starwood Property, it pays a little bit lower interest rate, but in a minute you're going to see that that had a significant benefit for the stock in itself. It was down to, if you look at the spaghetti graph, you can see it was down over 50%, but it's come back up, and actually it's up close to 10% for the year. So it's come back quite nicely. All right. The third one that we want to look at is going to be AGNC, and it's in green. And I'm going to show you this a little bit better in a moment, but they were down, not really quite as much. They were down maybe 30, 35%, and they're just a little bit below zero for the past year. Now, here's the one that really got hurt the most and hasn't really come back, and that's Two Harbor Investments. Two Harbor Investments, I believe, now I haven't done 100% research into this, and if you are buying it or you're thinking of that you own it and you need to sell it, you need to research this before you act on it. But I do think that they were higher leveraged, and they did sell quite a bit of the securities that they had, the loans that they had actually, into a market that was falling back in March and April. And it really hurt the company in itself. If you look at the stock at one time was down around 80%, and it's actually still down over 40%. And we're going to talk about the dividends of that in just a second. Now, PennyMac Mortgage Investment Trust is primarily residential mortgages. Now, remember that all of these they invest just a little bit differently, and their strategies are just a little bit different. But when we look at PennyMac is the one that's in gray. They were down to around 70%, and they've come back to where they're only down maybe about 5% for the year. So, there's some varying results based on the strategies that these investments have used for utilizing for owning mortgage-backed loans. And these are the kind of things that you need to look into if you're interested in buying into mortgage-backed securities, REITs that are based on mortgage-backed securities. Don't just buy it based on the current dividend. Look at some of the headlines that have come out over the past year. If you look back to March of 2020, March 25th, there was the PennyMac Mortgage cut its dividend by 47%. Agnc Capital cut its dividend by 12%. There's another article, and all these are referenced today in the show notes, where there's a gentleman, the CFA, that's talking about how risky that AGNC investments is. And then another thing that's happened significantly with Two Harbors investments just recently is that there's a large number of call options that have been issued on the stock. Remember, calls are options to buy that particular stock. It's a security. It's a contract, actually. That's referenced in today's show notes. There's also a study, which I found very interesting, that was recently in the Wall Street Journal. The title of it is "Commercial Properties' Ability to Repay Mortgages Was Overstated." That's what the study finds. And the study is actually an academic study. So you might find that really interesting. Now, look at the dividends. I love dividends. I think that dividends are great, but I want you to look at what happened over the past year with the dividends. I'm going to make it just a little bit bigger. We're going to go through each of these. All right. Agnc Capital, since 2015, and I've gone back to 2015 because that's a common date for all five of these. They had a big hiccup right around October of 2018, but they came back from that standpoint. Their dividends dropped in 2020, and they haven't really increased back up. Now, AGNC is a little bit different. They don't pay quarterly dividends. They actually pay monthly dividends, but they've been decreasing. So they're a little bit different too. But let's run over to look at the quarterly dividends from PennyMac. PennyMac has actually been one that cut its dividend, but it's come back. And then the quarterly dividends from Starwood Property Trust never changed. Very interesting. But the value did change. Now, the big drop was from Two Harbors Investments, and it dropped significantly, and it has not come back up from that. But one thing I want you to think about, and I want you to identify when you're looking at the different investments that are out there, these REITs, is what should you be doing now going forward if you own these, or if you're interested in owning these? You have to understand that the dividends are not guaranteed. That's the very first thing. Understand that the values are very sensitive to interest rates. Okay, before we go forward, I want to say thank you to our next sponsor, though, which is Advice for Life Insurance, because I talk about guarantees all the time, but I will tell you that the guarantees that are available through life insurance are ironclad. And thanks to Advice for Life Insurance, our sponsor today, they can help you to get life insurance. Your family needs you. You can protect them with life insurance. You can find the best life insurance at the lowest price in less than 5 minutes at adviceforlifeinsurance.com. All right, so where are we going with all of this understanding of interest rates, and what should you do if you own a mortgage-backed REIT? What do you do? Well, the first thing is to understand that the government backing is not going to protect your value. You have to understand that, ladies and gentlemen. I read a lot of the articles which are out there, some of them from the Wall Street Journal, where people write in and they say, one of the first comments in one of the articles that I read was, hey, don't worry about it. This was somebody writing in, don't worry about it. These are backed by the government. That's not a problem. That is absolutely wrong. There are securities that can go completely out of business. And if you look at some of the exchange traded notes, there's actually one that was from UBS. I didn't reference it in the show notes today because I didn't want to get into it a great deal. That doesn't exist anymore. It's MORL if you want to look it up, but they don't even exist anymore. So be very cautious of the investments. Understand that the government backing does not guarantee that the value will change. Now, ask yourself these 3 different questions if you own mortgage-backed securities, or if you are thinking about owning mortgage-backed securities. Now, I talk to you about individual investments all the time. And the way that I set this up is I'm here to help you identify stocks that will help you accomplish your financial goals. Ladies and gentlemen, it's so important that before you go out there just to buy an investment, that you don't buy it haphazardly. You think of it, how it's going to fit into your personal financial situation. You have to understand how it's going to help you with your goals and with your objectives. You're not just out there because you're at a lottery or you're at a Vegas table. Understand what your risk tolerances are and then reevaluate that in total. Keep this in mind. Interest rates go up, mortgage loans values will go down. If you don't understand that, go back and watch the video again, because I think that I explained it pretty good. There was a writer, a researcher for Morningstar that wrote about mortgage-backed securities trust in 2014. His name is Samuel Lee. He's no longer with him. He has his own investment firm. But his article is actually referenced in today's show notes. And Samuel Lee wrote this. Samuel Lee said this. He posed the question, what could possibly go wrong with mortgage-backed securities? Plenty. His opinion is that it's for as long as they've existed, like clockwork, they've blown up about once every 10 years. Now, if you want to read that article, go over to my show notes and you'll find it. It's the article that's by Samuel Lee from Morningstar. Now, I think that if you keep all this in mind, if you keep the idea in mind of the interest rates and the dividends, you will be able to determine if the stability fits your criteria, if the earnings are what you're looking for, and if the competitiveness of the investment fits you as well. So keep all this in mind when you're looking at your different investments, and hopefully this will help you to identify stocks, not just companies, but REITs that will actually help you to do what you're hoping to do. Please don't be one of those people that just buys based on what the dividend is. I've seen them. Years ago, I worked in as a stockbroker in a wirehouse, and I would hear other stockbrokers talk to clients and say, hey, this is backed by the federal government. This is paying 10, 11, 12%, whatever it would be. I cringed because the government doesn't back these things up. The way that they make their profits is on the spread. If you just got into this conversation at the very end of today's broadcast, go back and watch it again, because I think you're going to learn an awful lot. Hopefully this will help you so that you can find what's going to help you with your financial situation going forward. All right, friends, I thank you very much. Stick around for the disclosure that's at the very end of today's broadcast. If you're listening to it on the podcast, I'll speak it to you. If you're watching, it's going to roll across the screen. You can stop it. If you have a stock that you're interested in, write in today in the comments after you subscribe, of course, and let me know what you think. And let me know which stocks you're interested in, and I'll try to work it into the program. Thanks a lot for watching, and have a great day.